Welcome to the Deep Dive. Today, we're taking a bit of a shortcut right into the financial markets.
Yeah, specifically looking at it through the eyes of a research analyst.
Exactly. Think of them as like your guide sifting through tons of data to find what really matters.
That's a good way to put it.
We're using study notes from a financial certification exam, so,
Yeah.
pretty solid stuff we're drawing from. Get ready for some real insights.
And the core role here, it's fascinating, really. A research analyst is basically a selector. They dive deep into companies,
Yeah.
look at past performance, try to figure out the future, and then, make recommendations. Buy, sell, hold.
But it's not just crunching numbers, right?
Yeah.
You said it takes a sharp mind.
Absolutely. Numbers are key, sure. You need data skills, financial clarity, but also strong communication and, yeah, that critical thinking.
So what exactly are they, analyzing day to day? And what kind of recommendations come out of that?
Well, that gets us right into the heart of it. Securities.
Ah, okay. Stocks and bonds, mostly.
That's what most people think, yeah. But it's way broader. I mean, you've got derivatives, units from collective investment schemes.
Oh, right. Like mutual funds.
Exactly, those two. And even government securities. It's really anything that helps capital flow from those who have it to those who need it for projects or growth.
Gotcha. And this flow, it happens in different arenas, right? The primary market.
Yep, that's where new securities are born. Think IPOs, initial public offers, or FTOs, follow-on public offers, if a company's already listed but wants to raise more cash.
So fresh off the press, basically.
Pretty much. And then you have the secondary market.
That's where you and I would probably trade, right?
Right.
Like the stock exchange.
Precisely, where existing securities get bought and sold between investors.
Okay, so who are the main players making all this happen? Besides those regular investors, I mean.
Good question. You've got the investors and borrowers, obviously, but the intermediaries are crucial.
Like the stock exchanges.
Yep, exchanges providing the platform. Custodians are vital too. They hold on to clients' funds and securities safely.
Okay. And underwriters, they're important for the primary market, helping guarantee that public offers actually get fully subscribed.
Makes sense. And what about the big money, the institutions?
Oh, yeah, lots of those. You've got foreign portfolio investors or FPIs investing from overseas.
Right.
The various pooled funds. Mutual funds are common, but also venture capital, private equity, even hedge funds, each playing a different game.
It's a whole ecosystem. But, even with all this structure, human psychology must play a huge role. We hear about biases.
Oh, absolutely. Even the pros aren't immune. A really big one is loss aversion biases. Meaning we really hate losing money, much more than we enjoy making the same amount. Yeah, the pain of a loss can feel like twice as strong as the pleasure of a gain. It makes people hold on to losing stocks too long, hoping they'll recover.
I could see that. What else?
Well, there's confirmation bias. That's where you tend to look for and believe information that already supports what you think.
So you filter out stuff that disagrees? Pretty much. Or you interpret ambiguous info in your favor. Very common. And don't forget, herd mentality.
Following the crowd.
Exactly. Everyone's buying. Maybe I should too. Everyone's selling. Panic. It can drive bubbles and crashes.
Wow. It's a good reminder that our brains can definitely trick us when money's involved.
No doubt about it.
So with all these biases and complexities, how do they try to keep things, orderly and fair?
Regulation is key. Absolutely essential. In India, for example, the main watchdog is SEBI, the Securities and Exchange Board.
Okay, SEBI. And what do they focus on?
A lot of things, but a critical one is insider trading.
Using secret information for profit.
Precisely. Using unpublished, price-sensitive information that the public doesn't have. It's a major breach of fairness.
Right. And how do firms prevent that internally?
A common practice is the Chinese wall policy.
Sounds intriguing.
Yeah, it basically means building barriers, information barriers between departments. So the part of the firm that has confidential info, maybe from advising a company, is kept separate from the part that trades or gives public advice.
Okay, that makes sense. Separation of duties, kind of.
Exactly. And analysts themselves have strict rules. They have to disclose if they own shares in a company they're writing about.
Transparency.
Yep. And often they have to wait a certain period after publishing a report before they can trade that stock themselves. It's all about managing conflicts of interest.
So we've covered quite a bit today. The analyst's role, what securities actually are, the primary versus secondary markets.
The intermediaries, the institutional players.
And then dove into investor psychology, those biases like loss aversion and herd mentality.
And finally, how regulations like SEBI's rules and things like the Chinese wall, trying to keep it all on the level.
It really shows that understanding markets isn't just numbers, is it?
Not at all. It's this intricate dance, like you said, between the structures, the human element, and the oversight trying to keep it together.
Recognizing how these pieces fit together, how they influence each other. That seems like the real takeaway.
I think so.
So, thinking about all that, especially the biases, what's one thing from our dive today that might make you think differently about a decision you have to make, maybe even outside of finance? Something to chew on until next time.